All right, guys, like this is going to be recorded. Again, one thing I mentioned at the beginning of all of these, some of the guys that have been around for a while hear me say this time and time again, watch this over again, especially if this is new to you, whether it's even options or the way we're going to be managing these. There's a lot that goes into it. So watch it again so it sticks in your long-term memory. If you just see it one time, you know, it kind of goes into short-term memory. Some of the nuances may be lost on you. Watch it again and it will stick into your long-term memory, and you'll have a better chance of being able to implement this without having to go back and necessarily check notes or things of that nature. So do that if you got the time within the next couple of days, because if you wait a week or two down the road, it's going to be like learning it all over again. Anyway, let me get a couple of things out of the way. My name is Eric Wilkinson. Some of you guys may recognize me as the Wolfman, as we were talking about before we started recording, from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. I actually started trading with some of my own money in college with a psychology degree. Decided to switch it over to finance, moved to Chicago to work at the Board of Trade, and started out as a runner and then moved into the pit and started trading with that money I basically had earned and kind of accrued throughout college. So I used that to buy my badge and put some margin in an account, and here we are today. And this is a picture of Rick. So when we were talking about this beforehand, I used to do a little stuff, banter back and forth with Rick and a couple of other people on CNBC, and Joe Kernan in the early morning started calling me Wolfman, and it stuck. So that's a little history on that. But anyway, throughout that time from college and Chicago Board of Trade, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all of these products in all market conditions. And transferred from the floor to the screen, as you can see down here, my little Toshiba protege. Anyway, any opinions, news, research, or analysis, or other information contained here by ProTrader Strategies, associate companies, or employees is provided as general commentary and does not constitute investment advice or solicitation to buy or sell any of these securities, options, or anything of that nature. The reason why we can't do that is I don't know your risk parameters. I don't know what's in your portfolios, and so therefore what I'm doing could be counterintuitive of what you're doing. So take what we're teaching here, implement it into your portfolios in your own way, and make sure that this, what we're talking about today, is within your risk parameters. All right, I'm not here to just swim for you. I'm here to teach you how to swim, in a sense, or teach you how to swim in a sense. So anyway, you can follow me on Twitter at Wolfman's Blog, or you can follow us at ProTraderStrat if you are on Twitter. So I usually tweet out like around this time earnings trades that I'm doing, because I usually do those in the late afternoon and do an early morning market commentary to talk about basically every trade that I'm doing, when and where I'm getting out, how I'm defending that, and you know, how I'm setting these up. So nice little 10, actually try to keep it under 15 minutes. I actually try and keep it under 10 minutes, but I have a tendency to talk a little bit because I'll go over all the economic data and everything else. Anyway, so this is going to be on defending the earnings trades that we've kind of talked about over the last couple of weeks. Remember, we talked about how to set up put spreads, how to set up naked puts, how to set up call spreads, naked calls, iron condors, and this strangle. So in that, when we're taking advantage of these high implied volatility environments, you know, I've talked about this, generally speaking, around these binary events, we have high implied volatility, and it's usually overstated, but sometimes it does exceed or go outside of that when there's a bit more of a surprise in what the market was anticipating. And there's nothing we can really do about that other than be mechanical and go in and continue to stay the course and try and get this trade back into profitability. I'm not one of those guys that just kind of says, all right, I lost on that one. I move on. I'm going to show you different ways where you can try and stay mechanical, continue to get credits received in order to lower what your overall basis is on that one. So, for instance, I'm going to go over the first one. Since we did the calls and puts first, and it seems like a logical progression, we're going to talk about the calls and puts first, and then I'll go into the strangles and the iron condors. So the steps to defend the calls and puts, or naked calls and puts, or the call spread or put spread. Basically, it's going to be the same thing for any one of these. What we're going to end up doing is we're going to go in and sell the opposing strike. So if we went into this strategy or went into this binary event with a, say, a naked call or a short call spread, what we're going to do is sell a naked put or a naked call spread, usually when that call goes into the money. Now, even if it goes pretty deep into the money, I will be one to continue to stay with this process to lower my overall outlay of cash with that, because a lot of times with these binary events, something could really drop, especially right now with we're seeing the market at all-time highs. We're seeing markets actually beat earnings, and we're seeing some of these stocks kind of fall off. IBM was one of those. So, you know, in that, it's going to have a tendency to kind of have a bounce back. IBM not being the case in that one, but many of them over the course will do that. And if you guys have been, a lot of you guys I recognize have been around for quite some time. You guys saw what I did with Twitter on an earnings trade. It took me, you know, four or 5 months actually, trying to continue to stay the course, lowering my basis on that Twitter trade after I was losing money, and got it back to break even. Actually, it was a slight profit, but for all intents and purposes, I'm calling it a scratch. I think I ended up making 25 cents or 30 cents on it over that whole course. But, you know, that's usually a win, but to me that was like such a long slog. It did get back into profitability, so I guess I got to chalk it up as a win. Anyway, so we're going to do that when it goes in the money, or that our break even is being tested. So no matter what happens there, unless your overall outlook on this company changes. So if we're selling a naked call or selling a call spread, we were pretty bearish on this underlying going into it. Maybe they jumped out, came out with better than expected earnings, popped up. Well, if your whole mentality around this underlying has changed based on that type of scenario or what had happened, maybe it was their outlook changed, then I would be weary of going through this. Maybe just pull the ripcord on it, get out, and start looking at different strategies and other underlyings. Just walk away from it. There's nothing wrong with walking away from it if you've had a loser. But if you still are bearish in that underlying, think that, hey, you know, they didn't beat earnings and the market popped up, I think it's going to come back down, then that's when we're going to look to stay mechanical. And vice versa. If you were selling puts or selling a put spread and you thought the market was bullish, or that they were going to have bullish earnings, and the overall market came down and tested you on these, then you still had the same outlook or the same methodology that they were going to increase down the road, then that would be the time to continue with this. Otherwise, pull the ripcord on it immediately and just walk away. But this is in the case that we are still having the same mindset. We are going to look to stay mechanical with this and try to bring ourselves back to break even. So I mentioned this, we're going to sell a call or a put spread if the break even is tested, goes in the money, or a put, vice versa. And we're going to look for that 30 delta, all right? Even if it causes us to go inverted, because yes, we are going inverted. We are locking in a loss in that sense. But a lot of times when I've talked about this with these earnings trades, it could take several weeks for it to recover. So selling that 30 delta, all we're really trying to do is collect more credit, have those options expire worthless, and if it does come back up and kind of lands right in between our inverted strangle in a sense, we're going to have to be okay with that, because at the end of the day, we've staffed some of our losses in that because we sold that extra call or put that's inverted. So we're going to have a tendency to do that, because more times than not, it's going to expire out of the money, and then what we can do is either roll to a further duration. Now, you don't really want to roll to a further duration if you're inverted, but that one that is in the money is the one that we're going to look to roll out in time, because we're going to get more theta decay on it. Yeah, it's going to collect a nice credit. It's still going to look like we took a loss on it, but at the end of the day, we're going to have theta decay happening on the extrinsic value by rolling out in time, and then we can kind of play around with it, maybe sell something more like a straddle and look for it to come back. So we're going to roll for duration, because that gives us another credit, and trying to create a straddle or a strangle with it. But if you're inverted, I would stay away from really rolling this out in duration. If you're inverted and say for instance, I went into this with the short calls, all right? So I had on the short calls, market blasts above me, and I start selling some puts. Kind of makes me a little inverted. I would probably leave those calls, get out of those puts, and have that stock called away from me in a sense, which creates a short position. Vice versa, if my puts were tested, I would have that stock put to me and then start doing a covered call strategy. Even if I was inverted in that covered call strategy, say for instance, I was trading $100 or 100 put stock, the market drops down to like 95, I'd put that stock at 100 and then start selling some calls against it. Maybe it would be the hundreds, trying to collect about 30 cents, or selling the 30 delta. It could even go a little bit inverted at times. So we're just looking to kind of completely collect new credits, lowering what we paid for that. So, if we had a $100 stock and we collected 30 cents, now we own that stock at 99.70. If you can do that again and again and again, you can continue to lower what your overall basis is. So it lowers your break even, so it doesn't take as much to get back up there. Does that make sense to everybody, or have I lost anybody yet? I'm going to just make sure we're clear on this. We're looking to try and sell this 30 delta strike, similar to a covered call strategy, or if we're short the underlying, then kind of cover those puts. It's the same strategy, but the put is inverted where you're short. Does that make sense to everybody? Actually, the calls is when you become short. All right, so the other thing we can do is, like I kind of mentioned this, put the stock or have the stock called away, which if the stock is called away and you don't already own that stock, then you're basically synthetically short that stock, all right? All right, so, and I'm going to try and pull up the montage here in a little bit, and we'll be able to look at it a little bit more. So if we're looking at the iron condor or the strangle, this is where we're short a call and a put, and we were originally going at this strategy with like if you're short just the strangle, the 16 delta, and if we were short the strangle, or if we were short the strangle, we were doing the 16 deltas and the calls and puts, if you remember. If we're doing the iron condor, we had to get a little bit tighter to try and get a decent credit. So at the end of the day, we're going to keep it that way, where if you had the call spread and the put spread on and either one of those got tested, you're rolling the whole call spread or put spread to create an iron butterfly in a sense, which is that straddle with the defined risk. Same thing with the strangle. We're going to roll the untested side down to create a straddle or a strangle, and if it's not, and or we're going to be looking to be selling that 30-ish delta that we're talking about there. So again, we could be getting inverted on this. So it's kind of the same with the calls and the puts, where we didn't have something to roll down. Now at least we have something to roll down, and we've probably collected a better credit by doing the straddle, or sorry, the strangle or the iron condor. So rolling those calls into a straddle in a sense, or an inverted strangle. The other thing is we can also roll out in time. If this doesn't come back right away, we're going to extend duration. We're going to try and collect more credits. And we might do this for, like I mentioned, 3, 4, 5 option cycles and just continue to collect, 30 cents, 80 cents. Sometimes you'll be able to collect, probably 80 cents is going to be one of your best case scenarios, but you could even go really tight and collect maybe $1 or so. So, but 30, somewhere between 30 and 80 cents is usually the sweet spot for trying to do those credits. So I've got an example of one that went against me. So this was after the earnings happened, and as you can see, I originally would have been somewhere out in like probably the 30-ish delta, but this strike has gone into the money, and my calls aren't really in the money, so this isn't like a horrible situation, but with only a few days left, I would opt to try and roll these down just to make sure that I could kind of create a just tighter iron condor. Now, it would have been an iron butterfly had I rolled, or if I were to roll all the way down to the 35.5 strike. But again, I'm under the same methodology or same mindset that, it's gotten a little bit overdone. It exceeded what the market maker move was expected or what volatility had predicted for this. So I think that it probably will have a tendency to give back a little bit after everything settles down. So I didn't, I'm probably thinking with 16 days left to go, I could probably roll to this 30-ish delta and get away with it. Obviously, if my defined risk part of this was in, I would be going to the 35.5s, because that would probably be closest to the 30 delta. So Trevor's asking, so you're selling the 30 delta call put to create a strangle. The straddle if you are selling the 30 delta. No, so straddle is actually when the calls and puts would be the same. So, or the short calls and puts should be the same in this sense. So if I came down and sold these 35.5s, that would create the iron butterfly, or if I was naked, the calls and the puts without this defined risk, then it would be called a straddle. But if I even go just one tick out or even a half tick out, it's really still considered an iron condor. But when the calls and puts are the same, then that's where you get the straddle or the iron condor. So we're going to be looking to kind of roll down, collect a little bit more credit. So in this case, we would have been able to collect another probably 20 cents or so, something in between there, but 25 cents. And usually when I say we're doing the call spreads, we want to collect at least a third the width of the strikes. Well, when we're kind of going into defensive mode, it's kind of like we'll take just about anything we can get as long as it's not eating up, as long as it's not, our credit isn't being taken by our commissions, and that's so. Otherwise, it wouldn't really make it worth it to increase your risk for nothing. So we're trying to increase our risk in order to collect more credit. Rick, you're always good for it. I'm learning not to just keep going going straight to reading. You're complaining about Comcast. You should hear me complain about DirecTV. I actually have a direct line to customer service now. I don't have to push all the buttons because I've had to complain so many times. They finally gave me a direct line. Anyway, so we're going to be rolling to like this 30 delta. So, it's 30-ish. And, if you wanted to be a little more aggressive with it, you could go to a little bit higher. With this one, 16 days to go, I would probably decide to give it a little bit more breathing room. If it was only 2 days to go, I'd probably go straight to maybe the 35.5s and create that iron butterfly. Would you consider for the naked collar put to convert it into an iron condor or butterfly? No, because for one, we would be able to, when you're naked, you've taken on so much risk to the other side, and to buy in and define that risk on that side, I wouldn't want to do it because I'd want it to, it's really, in a sense, throwing good money at bad money is the way I would look at it, because you're going to be, for one, adding more, you're going to be taking risk away from it, but you're going to have to end up paying probably more than what you originally collected for this strategy. So if I were considering doing something like that, I would probably look to just cover this strategy if I thought it was going to, in this case, continue higher. If I wanted to limit my risk to the upside, I'd probably just cover it, because that 48 cents that I'd have to pay for these at this time is probably going to be almost as much as what I originally collected for this overall strategy. I would guess for this strategy, I would have collected somewhere between 30 and 60 cents, depending on how far out I was on the option montage. I probably would have been doing like a 16 delta. So that probably would have given me a total of somewhere between the 16 and 30 delta. If I did the 16 delta on the iron condor, I probably would have collected about 30 cents. If I would have been doing like the 36 delta-ish, then, or 30-ish delta, I probably would have been collecting close to 60 cents. So by buying that, at 50 cents on this side, it's probably going to eat up more than half of what I originally collected. So I'd probably stay away from that, but and just keep it the same straddle on the other side. So if they were naked, if this was naked and we pretended that these puts weren't here where the puts and the calls where the defined risk was, I'd do the same thing. If I went into the money on these, I would just roll down the put to about 30-ish delta. Now, if it was deep in the money, then I might have to go inverted. Say these were, the market traded all the way up to maybe 37 or so. So I'd be short that far in the money. I'd probably end up having to sell something like the 36s. So I'd be slightly inverted because I'm short calls at 35.5. I'd be long the 36 puts. So, or sorry, I'd be short the 36 puts. So it would be inverted. So I would be locking in a loss in that regard. But if it's that tight, 50 cents, I probably would have ended up collecting enough money where if it kind of landed back in here, it would have been a scratch. But sometimes you will be locking in a loss if it were to come back in. And that's fine, because that loss isn't going to be nearly as much as the loss would be if you didn't get that aggressive and it only came back to, like, say 36.5 or 36. Those are still in the money, so you would have lost some money there, and it probably would have been more than if you were aggressive. Your margin isn't going to, Trevor's asking about margin on this, your margin is not going to really increase more than what you were originally outlaying for the margin if you were naked. I think is what you're really getting at. So you're not really increasing your margin requirements by doing this. With the butterfly or sorry, with the iron condor or with the rolling into an iron butterfly, or if you had the strangle on and you rolled it into a straddle, your margins are not going to increase that much. They probably wouldn't increase at all, to be quite honest. Yeah, I don't think they're going to increase if you're naked either. All right. So, so this is just the example of when I rolled this down to collect another credit. So, you know, selling the 59s, buying the 36s. You know, worst case scenario, I'm collecting at least 20 cents. I probably would have ended up selling 60s and buying, say, 34s. So, you know, you're collecting a nice little credit there for that. So at the end of the day, if the market didn't change there, but if the market kind of came back off and kind of pinned right here somewhere in the 35 and a half, we'd be all good. Even if it settled right here, you know, and went out right around in this area, it still would have been good because I've collected enough extra credit for that. Say, for instance, if I caught the, you know, got collected around 27 cents for this and originally had it for, say, 70 or 65, 60 cents or so. We're getting about a total of 85 cents, so that's pretty close. And after a couple of days, you know, these are going to decay. These are going to get theta decay out of them. So that will help as well on the call side. So it's all going to decay a little bit more. So you'll be able to buy back for less, you know, if it stays there. And if it continues higher, especially with the iron condor that we've created here, a tight iron condor, if it continued higher, remember if we collected 60 cents at the beginning and we collected another, say, 25 to 30 cents, you know, our risk has been diminished to 10 cents to, say, 15 cents on the whole strategy in this. So if it does continue to rally up, by getting aggressive right away, you've diminished your risk on that. And if it comes back and settles right in between there, then you're really happy because you've increased your credit and done very well. So that's the whole idea, is you're just trying to limit, you're trying to manage your risk and limit what your losses are for this. Because at the end of the day, you know, if you would have gotten out of this, you know, you could have lost like 25, 30 cents, and now you've decreased that to, you know, 10, 15 cents. So you've cut your losses in half if it were to continue. And if it stays right here, then, you know, you're actually probably going to end up with a profit. Does that make sense? How that would work? So what we'll try and do here is, because I got quite a bit of time, I ran through that rather fast. So does anybody else have any questions? I kind of ran through that pretty fast with how we're going to be working those out. So for instance, let me get rid of this here. Let's just look at anything that has, doesn't really matter. Let's look at Lulu. Lulu's been trading in around the 50s anyway. So what we can do is look at, we can look at like the theoretical value and marks. So to play around with this in a sense. So originally what we were talking about, so we're looking at calls and puts. So we're going to look at the deltas on this first off. So if Lulu is having earnings, I'm just trying to see if anybody has any earnings really soon. You know, usually if I'm doing this as a naked straddle, I talked about this, we're going to be selling the 16 calls. So we're going to be looking to sell those and then come over here to about these 16 puts. to sell those, or the 16 delta puts, and sell those, collect about 45 cents. That's a nice little trade there. Now, if this market were to move, tomorrow, so we can kind of do theoretical values despite the fact that the market isn't open tomorrow. It's not going to recognize that. So we can do theoretical, and what we can look at is, change the date correctly, add a day to it. So like tomorrow would be the move. And let's say, for instance, we got a move of, we're trading at around 2.52. So we got a $2 and say $2.60 move. So $2.50, $2 and let's say it's a $3 move, because then that would be a part of our commissions, right? Because our commissions are now giving us leeway to 55. If we collect a total of 45 cents for this strategy, our break even is really close to 55. So if it goes to 55, that's a $3 move higher. So let's just say we got a $3 plus move, positive. We can look at it on the other side. And usually what we're going to see with this is have volatility really crush. So I'm just going to say that we get like a 60% decrease in implied volatility. So see how I did that? So we got negative 60%. So that means that this is going to decrease by 60% in volatility. So what's going to happen is, this goes into the money by 50 cents. Those are only worth, it seems a little wanky, but 30 some cents. There are 47 cents is probably closer. It's probably even, it could even be a little bit more than that, because our break even wouldn't necessarily be broke. So let me try and change this to 50%. And you're not going to change it all. All right. So they go, so we got 47 cents. In that, we can look over here at our theoretical pricing, and it's acting funny because these actually should be worth something over here, just at least a little with 14 days to go. And we'd be able to sell some credit here. So this is not giving me a very good example. I'm not sure why. Maybe it is happening to get messed up on a day off kind of thing. Let me check. So 22 cents, we would have collected 45 cents. For some reason, let me do it as a negative and see what happens. Negative $3 move, price adjustment. And then let's just look at it without the volatility decline, just for example purposes. So, and we got 1 day theta decay. So 1 day theta decay. I'm not going to adjust the volume. Could be because the implied volatility is so low already that it's kind of having trouble with it. Anyway, so the market goes down by $3. So now our 49.5 puts are in the money. So we've gone from 45 cents to them being worth about, these calls increasing by about $1. So we've collected 45 cents. So now we're going to need to roll these down to like a 30 delta, which is going to probably be ballpark, probably these 50.5 calls. So we're going to roll down and collect another 36 cents. No, it's not a ton of money, but at the end of the day, what we're looking for is this market to kind of rebound a little bit. And now we've increased our credit by 36 cents, so our overall outlay is now 81 cents, right? So we've increased our break even to the downside even. So if that market were to continue to the downside, after that big move to 49.5, and we're in the money there, and they go down another, 30 cents or so, that's just increased our break even by that much. Does that make sense? Because right now our break even is right around 49 at the end of the day. So then we've increased it just below 49. So we've given ourselves another bit of distance to go down. Now, if it continues to go down in the next 14 days, because we've done that 30 delta, we've given ourselves the chance to roll down again to the 49.5. All right, so then that's where we create our synthetic short straddle, where we're sold to calls at 49.5, and we were already short the puts at 49.5, increasing our credit again, even if you're only collecting another 20 cents or so. At that point, it's usually where I'm going to hold on to it, see what happens for maybe a couple of days. But once we get inside of like 7 days on this, and if you had done this like 2 or 3 days or 7 days, let's say we had done it in the May, then I would probably do one roll, see how it works out, and then I would roll this out in time to the June, and I would be short those. I probably have to roll it to like the 47.5, since they're not giving me those strikes, which is a problem sometimes, or the 50s. Maybe I'd end up making it the 50 straddles. So that's another reason why I don't like using the half strikes. You guys have watched a lot of my videos and stuff like that. You guys know that I like to kind of keep to the rounded off ones. I usually default to that, but in this we'd be short the 49.5 straddle. Then I would probably roll it to the 50 straddle. That makes sense? After the market close on Monday, if you're looking for an earnings play, any attractive option plays? Good question. I'll look at those. Hold on a second. RGR. I don't usually trade. Yep. I usually, Ted, what I usually do for a rule of thumb on these, because of volume and open interest in this, I might stay away from this one, unless I knew this stock very well and knew what the trading was going on in this. I like to look for a lot of volume and open interest, because that creates a lot of players in here. And I have a rule of thumb getting into strategies that if it is like under $100 stock, that the bid ask needs to be around 10 cents wide. The reason why is because, even sometimes during earnings, I'll go into stocks that don't usually get a lot of play, but will get a lot of participation during earnings. But this being a little on the wide side, if we look over in the puts, we got 40 cents wide, which can be very difficult to get in and out of, because you just kind of get eaten up with the amount of edge you have to give up getting in and the amount of edge you have to give up getting out. Now these 18 deltas are actually right there at the 10 cents, and you might know better than me whether or not these markets get tighter during the earnings, but usually that's my rule of thumb, is these ones that are close to at the money or a few ticks out, at least to like the 16 or the 10 delta, need to be about 10 cents wide for me to start getting into these. And that's the only one that's really 10 cents wide. So, and it's got a $3 expected move, so 63 to the upside. So you'd have to sell these 65s to get outside that market make move. So, I don't know if you'd be able to get this trade off for 25 cents in here. And then $3 to the downside would give you 57. So you'd have to sell these, which is actually a pretty nice premium. You have to sell these at least. $3.30 probably these. So whether or not you'd be able to get 30 cents for those, I don't know. You might know better than me. All right, so I'll check out your other one too. J2 Global. So yeah, these are even wider. It's a, it's a $90 stock, so you'd expect a little bit wider usually, but we're talking 60 cents here. And the thing is after the earnings, you might have a winner on there, and you'd have to pay a scratch to get out, because look at some of these. I mean, there's just nobody even in there. Pay to get out for a scratch, even though you're a winner, with just giving up the edge to get in and out. So we can check to see if there's any other earnings on Monday. Anybody know if there's anything coming out after the close on Monday besides those two we could look at, because we've got a little bit of time here yet. So I'll try and check one out and put one on, and then you guys can check the daily market commentaries to see if I get stuck with one. Probabilities are in my favor though, because I got one of the first ones I did was IBM, and it didn't work out. So I'm feeling like the probabilities are in my favor for the rest of the time. So let's see, Morningstar earnings calendar. Does anybody else have any quick questions before we keep going too much? So usually what I'll do is check out Morningstar here, and we got to go to Monday after the close. So Monday, ABT. I usually just run down the side here real quick, looking for something interesting. Try and find something after the close on Monday, and let me know, because I'm kind of trying to scan really fast. So if you see one in this list that you want me to look at real quick, we'll try and hit one up real fast if I don't waste all my time looking for something. Pandora. I think Pandora is really low price stock though right now, so it's probably not going to. There's your RBC. So let's look at on Monday or on Tuesday morning. Try and go before the market opens. Wayfair doesn't look very interesting so far. Anybody see anything good? Thought I saw it. They're all, I don't really see anything. Watch the daily market commentaries, because I'll be doing some on Dean Foods. I don't think has very good markets. CBOE. You'd think that CBOE being an options, Aon might have some good ones. Priceline is next week, so let's look at Aon real quick, because sometimes around the earnings, Aon will get good markets, and they don't. Who did you say Priceline? It's not really close enough to get the market maker move, but we can figure it out. I'm going to have to pull out my calculator because numbers are too big for me right now. So Priceline, let's figure out what the market maker move is, because we talked about this. It's not always going to show it to us. So we'll figure out what the straddle is. It's trading 08, so this is, or 05 I should say. So right here is probably the straddle, the closest to. So just for ballparking, pick, let's say 49 is mid-price there, and then 49 and, let's say 49 and 49. So 49 and 49 is 98. I don't even need to do it. So 98 times point. Does anybody remember what we multiply this by to get our what our market maker move is? Ah, yeah, everybody blowing me up. Everybody, oh yes. Okay, you guys did your homework. 0.85 is correct. So $83 move expected in price line. So 83 to the upside, 83 to the downside. So 83 to the upside, I'd need to pull up a lot more than this, because we're going to try and get up. And as a matter of fact, we could probably even do this with price line because it's such a big dollar stock. I would probably, with these really big ones, sometimes I'd just double the market maker move. So I'd be going like $160 to the upside and to the downside. So that put me at 20. So I need to put up, let me say, 70 in the option montage. So 160 to the downside would put me at about 1740. Still not enough. I'm not going to have enough time to go on it. Snap, that's right. What STD after the open on Tuesday morning? Oh, yeah, we could look at that one. STE. So see if they got it. And see, they're having real wide ones also. Somebody else said TSN. Tyson actually, you know what? Tyson probably has tighter markets in the, the closer we get, because I've traded Tyson for earnings, and I think, especially that day before their earnings, these markets in Tyson are going to get a little tighter. I mean, they're just outside of what I normally like to play with for one of these, but I know Tyson does get tighter around their earnings. And somebody said EOG, which I don't know what that one is, EOG. Huh, may have to start $90 stock. It's pretty close to 10-cent wides. So so we got about a dollar, let's say $1.80 and $1.40 for our thing. So $1.80 and $1.40. Should be able to do this in my head, which is 320. So so $3.20 times 0.85. $2.70 move. So we're looking at $2.70 the upside. So we're going to be looking at 93.50. So 93.50 to the upside. We'd be looking at selling these 16 deltas here, and that's inside of 10 cents. I'm going to put EOG on my. I don't even know what they do, but I'll trade them. Put those over in my. And look out for those earnings. So, because they do have pretty decent markets. So I'd be selling like these 95s, and then on the 16 delta on the downside, I'd probably default to the 17s, like 71 cents for it. So if that move happened, I would be rolling down to like a 30 delta when that happened. So you can expect on a 30 delta, with applied volatility going down a little bit. That's what I was talking about. You're probably going to be able to collect about 50, 60 cents, 30 at the low end, and you just kind of continue to do that. All right? So you roll into the 30 delta, even if it causes you to go inverted, like I'd be selling the calls below where my puts are. Now, it seems counterintuitive, but usually what that means is, if you're selling the 30 delta, you're still a few strikes out of the way, so you're just trying to staff the bleeding a little bit and collect credits. And this is one of those things that you're probably going to, have the stock put to you if it goes through your puts on the downside, and just continue to work at it, where you're going to be long at 87, so you're going to be selling calls against it to try and lower what you paid for it overall. You're going to be long the stock at 87, but all your credits have lowered the price that you paid for it. Does that make sense? Yeah, NVIDIA has earnings next week. Usually when it's like a few days ahead of time, they're not going to give you the market maker move right away. And the other thing is because these May are expiring, there is no market maker move on the earnings. It's hard to figure out because those are still kind of being, kind of in play. So market maker move is going to be basing it off of the closest to expiration. All right. That's all I got for you guys today, other than this is our premium membership offer, 2 months for the price of one. So like if you guys learned anything at all, throughout this, I know nobody else really teaches this, but this is what we used to do on the floor when, the going got tough. This is how we stayed alive in a sense, because we would continue to stay mechanical. We didn't look at it like, you know what, you're going inverted, that's the wrong thing to do necessarily. We were looking at it like, I need to collect more credits. I need to collect more money and continue to lower my basis. And that, I mentioned I started trading in college. That's what I started doing in college is I had this money I'd earned and put it all in the bank. And this guy came up, hey, maybe you want to do discount brokerage, and started investing in stocks. And then I started complaining because I had IBM and I had Walmart on at the time, and Walmart just couldn't stay above 50. And I was complaining, I shouldn't have bought these two stocks, And he was like, well, you can start selling calls against them. So that's how I got really started even in options and started trading by lowering my overall basis on what I paid for those. So I didn't care if it got called away from me above 50 in Walmart. I was like, whoever's a sucker and buying Walmart at 50, it's going to come back down to 47, and that's where I'm going to buy it back in again, because I've watched it too many times go to 50 and come back down to 47 and never sold it. So so that's how I started playing that. So at the end of the day, if you've learned anything at all from this webinar, this is a great deal. You should take advantage of it, because and not only in the webinars, but in the daily market commentaries, I think you guys can learn a lot from that, because I go into detail as to, on a daily basis, what I am going through, how I'm defending strategies, how I'm, what my mindset is, whether it's based on the charts and stuff like that, why I'm putting on this trade on. It could be economic, geopolitical stuff too, with crude oil. If you guys have been watching crude oil, I was saying it was overbought for a long time. I mean, it kind of ran against me, but we got that pullback. Now I'm starting to look to get long crude oil, because I think it's a little overdone to the downside. I think we could get a little bit of a bounce here. So anyway, I talk about all that stuff in these daily market commentaries. So for the $97 or half of that, 40 some odd dollars, to get all those daily market commentaries for 2 months is probably worth it in and of itself. Also, you get access to the trading workshops, which are going to be these webinars that we've kind of put in archives that you guys can go back through and see all the other strategies that I've done webinars on. And then I also have some other videos where they're a little bit shorter in duration, where they're kind of refreshers, so you don't have to watch a full webinar to figure out what some of my methodology is on the iron butterflies, iron condors, straddle strangles, spreads, and everything else. You can kind of get a refresher. I don't go into a lot of examples for those. I just kind of go through the methodology. The webinars, I think you get a lot more, because we have to give and take back and forth talking about what's going on. So it's definitely worth it. So if you want to trade like a professional trader, or like what we did it on the floor, how I was taught to trade on the floor, then you get all of that in here. Plus with the premium membership, you get access to me. So that means if you have something going wrong with a strategy, or you want to run a strategy by me, or you want to even talk to me about earnings on a particular stock and maybe what we should kind of look at, I can tell you what I would do, and then you have to kind of take that into account for yourself as to whether or not that's appropriate for you, but that's how we can play that back and forth. You have unlimited access to me on those emails, so take advantage of that for sure. And you can contact us at 310-598-6677. This link is in the chat window, so click on that link. It's a direct link to that. You can also call us up and talk to us, get this all set up. I mean, there's a great discount, especially because you're getting all those different videos and everything else that we usually charge extra for. But as a premium member, you get access to those. All right? That's about all I got for you guys today, other than, if you take advantage of this, it could, in that 2 months, it could easily pay for itself in what you're going to learn. So the only thing we can do to get better, you guys, is, increase the what we put in between our ears in that gray matter. So you really need to, the more you learn, the better you get, and that's what you got to do. And I'm still constantly looking to learn too. So I'm doing the same thing, trying to get better for you guys even. So, all right. So all these courses are designed to create consistent winners. That's what we're talking about. Playing the probabilities, creating consistency, staying mechanical. Psychology is more involved in trading than even finance, you guys. So if you can get rid of the emotion, you will be a better trader, and that's what I try and teach you in these, how to stay mechanical. You don't look at it like I'm losing money or I'm making money. You look at it like I'm beating probabilities or I'm not beating probabilities. And that will make you more of a consistent trader once you learn how to do this. All right. I want to thank you guys all. Click on that box in the chat window. We've been talking back and forth in the questions, but the link here is in that chat window. In later webinars, I'm going to be drilling down on different options, components, trades I find, when and where I find them appropriate. Also, you can reach out to us at trading@protraderstrategies.com with any questions if you want to reach me. And if you want to see me do a webinar on a particular strategy that you may not have seen, or I haven't done it in a long time, and you want to see it with real live examples, reach out to us. Let us know. We're always looking for ways to serve you guys better and be better ourselves. So you can reach us at 310-598-6677. If you're watching this on tape replay, you'll just have to pause it, write this down. It's pretty easy. Options Premium Membership 2 for 1. It's not a link that even I can hit on right now, so it's a dead link. The real link is in the chat window. All right, that's all I got for you guys, other than if you can't take that, take it easy. JQ, I think you almost beat me on that one. Have a good weekend, you guys. Take care. Thank you, guys. Thanks, Ted. Bye, y'all.
you.